Global market outlook, the many walls of worry. The mood in financial markets is shifting away from worries about inflation to worries about growth as a result of the Fed's aggressive monetary policy. For risk assets, though, bad news has been good news, as the rise in long-term bond yields has halted. We continue to see income-driven multi-asset allocations, adding exposure to bonds at the expense of equities, and a preference for Asia ex-Japan equities, as three strategies that are most likely to balance growth and inflation worries. Increasing worries about growth have also dragged commodity prices. However, we expect a floor to emerge under oil amid continued tight supply, while gold could rebound as the USD and bond yields peak. Investment strategy and key themes. What should I worry about? Over the past month, there has been a perceptible shift in market sentiment away from worries about inflation to concerns about economic growth due to the Fed's aggressive actions to quell inflation. Somewhat counterintuitively, this has had a positive impact on market returns, as growth worries have halted the rise in long maturity bond yields. From an asset class perspective, a few trends in recent weeks stand out. 1. While short-term bond yields have continued to rise in response to higher Fed rates and still high inflation, long-term bond yields have remained below June's peak as growth worries mount. 2. The bad news on economic growth has been good news for equities, as the rise in bond yields slowed amid what was already extremely bearish positioning. 3. Oil and industrial metals tumbled. Amid worries, demand would falter with growth, especially amid a renewed COVID outbreak in China. And 4. Gold fell as the past rise in bond yields and the USD took their toll. Nevertheless, our asset allocation views from our H222 outlook remain unchanged. Central banks continue to walk a tightrope, balancing between curbing inflation and avoiding a deep downturn. We continue to see multi-asset income assets, a rising allocation to bonds, and a focus on Asia ex-Japan equities as three ways to navigate this environment in foundation allocations, keeping foundations unchanged. The modest rebound in high dividend yielding equities, a pullback in long maturity bond yields, and a bounce in high yield HY bonds have been recent positives for multi-asset income strategies. While growth worries could still create some volatility, we believe the circa 6.3% yield on offer and the likelihood of a continued outperformance of long maturity bonds and high dividend yielding equities in an environment of growth worries will be supportive for the strategy. Meanwhile, global equities have outperformed bonds slightly since mid-June lows, though the two have largely moved in tandem. We remain comfortable with our view of adding exposure to bonds at the expense of equities, especially as growth concerns rise, but re-emphasize the need to retain a balanced stance between the two. Our regional preference for Asian equities has been challenged in recent weeks amid a stream of negative headlines. Recent volatility notwithstanding, we note Asian equities have continued to outperform global equities from the start of Q2 22. We remain comfortable with our preference for Asia ex-Japan equities, as we believe valuations remain at levels that more than incorporate recent concerns in China. 2 worries for credit markets. There have been concerns about whether US and European HY bonds are at risk if recession worries do indeed pan out. Credit spreads on US HY bonds are currently at levels comparable with the 2018 sell-off. The level of equity volatility and our assessment of the relatively good credit quality of US corporates. While a return to 2020 recession peaks would mean an approximate doubling of this yield premium, we would note that 1. Such a move would most likely need a deep recession, and 2. History shows such moves are usually quite short-lived, given the attractive yield starts offsetting negative price returns much more quickly than for equities. We continue to see US and European HY bonds as preferred. The second area of concern has been the possibility of rising default in emerging market. USD government bonds, as the USD stays strong, and USD borrowing costs rise. This is arguably already reflected in yield premiums that are at their highest since 2020. Having said that, we would note 1. The EM USD bond asset class remains well diversified, with each sovereign issuer comprising less than 5% of the total asset class. And 2. Emerging markets scoring relatively low on a range of debt and liquidity metrics have remained arguably small in numbers so far. While history demonstrates it is prudent to be on watch for contagion risks, we do believe valuations have already factored in a significant amount of stress. We retain a core holding view on EM USD government bonds. What matters for oil? Demand or supply? Have oil prices peaked? The recent peak does coincide with rising concerns about slowing economic growth, which is likely to impact oil demand. However, we would note that supply remains highly constrained by most measures, leaving the market at the risk of a grind gradually higher, especially if China's policy efforts to support growth are successful. This is likely to limit the weakness in energy sector equities in our assessment. Foundation. Tactical asset allocation. Perspectives on key client questions. What is the outlook for a balanced 60-40 portfolio? Investors have witnessed a painful start to the year. Both global bonds and equities are down 15.6% and 12.4% respectively, driving a 60-40 allocation 14.3% lower year to date, making it one of the sharpest declines over the past 150 years. High inflation, the Ukraine war, and unprecedented tightening by central banks have weighed on investor sentiment, triggering concerns about a protracted growth slowdown. Will the sell-off continue? How will risk assets perform in H2 22? There is clearly an unusually high degree of uncertainty on the outlook, given that the world has not witnessed such an environment of high inflation and slowing growth in the last 4 decades. Under such circumstances, the natural human tendency, psychologists call it recency bias, is to extrapolate the first half's pain into the next few quarters. However, in times like these, it would be equally important to remind ourselves that it is rather unusual to have both bonds and equities declining at the same time. A review of the history of US financial markets provides some reassuring facts. Over the past 150 years, there have been only 4 years, 1931, 1941, 1969, and 2022 year to date, when US bonds and equities both declined. A typical 60-40 stocks bonds allocation posted 9 annual losses of more than 10% since 1872. The only occasion where a 60-40 allocation suffered 2 consecutive years of losses, exceeding 10% per annum, was during 1930 to 1931, in the midst of the Great Depression. Returns to date have tracked some of the worst first-half episodes for a 60-40 portfolio. However, after a dismal H122, history shows returns tend to improve in the second half. Today, investor sentiment and positioning are also extremely bearish, suggesting it may not need much of a reversal in sentiment for a technical rebound. Thus, history suggests long-term investors should lean against any recency bias. However, the coast may not be entirely clear. The US economy slipped into a technical recession in H1 22, with initial estimates showing that the economy contracted by 0.9% in Q2, following a 1.6% decline in Q1 22. Business confidence indicators have deteriorated alongside a sharp decline in housing market activity as mortgage rates rose. Though the US labor market has been extremely resilient thus far, the real question is whether the continued Fed policy tightening will drive the US economy into a deeper and protracted recession and earnings contraction, which markets have yet to price in. High and sticky inflation would raise the risk that the Fed continues to tighten even in a significant growth slowdown. While supply chain bottlenecks have eased somewhat, shelter and services inflation have picked up more broadly. The risk of a disruption to Russia's oil and gas supplies is also a factor that may drive the Fed to hike by more than the circa 3.5% currently priced in by markets. Under this scenario, there could be further near-term downside to the 60-40 portfolio should we bottom fish. Both upside and downside risks appear equally balanced for now, which suggests investors should remain broadly diversified without taking overly concentrated risks. It is hard to pinpoint the perfect time to invest. A peak in Fed rate expectations could be one such catalyst, as evidenced by the gains in equities and bonds, after Fed Chair Powell hinted of a slower pace of rate hikes if inflation decelerates in the July Federal Open Market Committee meeting. On the other hand, there is no need to excessively time the markets if one can be disciplined in investing on a regular basis. Broadening one's investment allocation is a better way to improve the probability of achieving positive returns over the long term. Our thematic ideas, key themes. Below, we provide a brief overview of our open thematic ideas, coupled with some recent highlights. The winds of climate change. The recent rebound in global markets has offered support to our climate-related themes. Our water theme has been an exception, outperforming global equities by circa 8% since we published our H222 outlook. However, valuations and earnings revisions remain less supportive. In the near term, inflation pressures and an ongoing energy crisis remain headwinds for climate themes such as clean tech. However, we retain our conviction on the back of cost competitiveness versus fossil fuels and continued policy support worldwide for decarbonisation. Clean power remains the cheapest form of power generation, despite recent cost increases, as reported by International Renewable Energy Agency in its latest renewable power generation cost report. Additionally, we continue to expect demand for clean energy sources to increase. Although markets are growing more cautious about rising recession risks, we believe that existing structural tailwinds could boost climate-related themes over the longer term, outweighing the short-term headwinds that have been dragging climate themes in broader global stocks this year. Embracing a digital future. While our cybersecurity sub-theme recorded positive returns of 2% since the end of June, it has underperformed both global equities and the Nasdaq Composite Index. Nonetheless, structural trends with the pandemic accelerating the pace of digitalization, which has in turn highlighted the need for cyber resilience among businesses, gives us confidence to retain our conviction over the longer term. Cybersecurity surveys have shown that the majority of C-level executives agree cyber resilience would be considered a business priority in 2022. The underlying shift towards a safer digital space can be seen in rising demand for cybersecurity products from a broad range of industries, from insurance to software to services. Thus, forecasts for cyber protection-related spending continues to increase. The global cybersecurity market is predicted to grow to USD $340 billion in 2026, up from USD 240 billion in 2022, according to Statista. In terms of valuations, 12-month forward price earning currently trades at a premium relative to global equities. Although rate hike expectations and the inflation growth outlook will remain dominant influences on the sector, earnings revisions have ticked up. We believe this displays confidence in the theme's fundamental outlook amid the ongoing market uncertainty. This supports our conviction. China's common prosperity. While the renewable sub-theme of China's common prosperity thematic idea fell 7.9% since the end of June, we continue to remain positive on the sector. Long-term structural tailwinds remain intact, in particular for new energy vehicle producers. We see the recent drop in 12-month forward price earning from its June peak of 23.4x to 20.3x as an opportunity to gradually add to positions. The easing of China's COVID-19 lockdowns in June and the subsequent release of pent-up demand has propelled sales of NEVs to a new record high of 596,000 in June. Year-to-date sales of 2.59 million means full-year sales are on track to reach 6 million, as estimated by the China Passenger Car Association. However, a high base in Q4 21, a reduction of sales tax that is likely to primarily benefit internal combustion engine vehicles, a renewed COVID-19 wave, and the risk of a slowdown in immediate demand in the event of an extension of subsidies into 2023 mean NEV sales could start to slow on a year-to-year basis, allowing ICEVs to regain some market share in the near term. Nevertheless, monthly NEV sales are still likely to see healthy, albeit slowing, double-digit percentage growth from the previous year, enabling FY22 sales to increase by circa 70% from 2021. Over a longer horizon, the phasing out of ICEV production in 2025, as recently announced by some Chinese automakers, and the country's goal to lift the share of NEV sales as a proportion of total auto sales to 40% by 2030, mean that strong structural demand for NEVs is likely to remain in place in the coming years.